Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Ryan Davies. Ryan is a senior portfolio manager of Manulife Investment Management's U.S. Small Cap Core strategy, which focuses on companies with market capitalizations ranging from $1 billion to $20 billion. Ryan has nearly 30 years of investment experience, most of it focused on the small cap sector. Ryan, welcome to the Compound Insights podcast today.
Thanks. I'm excited to be here.
Ryan, can you given your significant tenure in this market cap range, how would you say small cap research or your process has evolved over time?
So, as we've gone through time, sell side research has continued to go down for smaller cap companies. So for that, it's allowed us to pull up our sleeves and really discover companies that other people aren't looking at. I remember back 20, 25 years ago, there'd be 10, 15, 20 covering analysts on small cap name. Now, sometimes we're lucky to have 3 or 4. So for us, there's a discovery process that allows us to find names that others haven't found. And that seems like every year it gets a little stronger, the opportunities get a little bit stronger because there's just less focus on these names.
And in that discovery process, is it through screening tools, industry contacts, management teams, or sort of some combination of those?
I'd say it's all of the above. For me, I like to describe it as I use a qualitative funnel to analyze businesses. I've tracked it over my career. I've averaged somewhere between 200 and 250 meetings a year with companies. That might include a one-on-one Zoom these days, but it is one-on-one meetings. And I'd say that's the same thing for the entire team. And that's where I think we find some of the best ideas is just from those one-on-one meetings and just trying to discern over time. You can sense differences in companies you know. You can sense differences in companies you don't know as far as when things change and there's a catalyst upcoming for the business because people can't help but show their enthusiasm when something's good in their business. And then the other side of it is it's also obvious when something's not good in a business. Sometimes you can see that with people when they're talking to.
And do you think there's still some aspect of this market cap range that's not fully understood or fully appreciated by the market or investors?
Typically, these companies, and especially some of the stuff that we do, we're focusing on companies that sometimes they dominate or even define a niche. So they're the Kleenex of their business. I mean, as an example, we own Trex, which is composite particle board or composite boards for decking. You call them Trex because they kind of made up the name for the industry. But these businesses can be more volatile because they're not as diverse as a large cap. So you will get quarterly dislocations. There might be a sales force change or just somebody has too much inventory. So I think a lot of investors choose to ignore these because sometimes you have to have duration because you will get those stumbles unexpected. And you have to live through those and use those to your opportunity. So you'd ask, how has our process changed? I'd say is that we have to use that volatility to our advantage. Volatility is significantly higher than it's ever been. And I don't think that's going away. And we just as a team, we like to preach, just use that to your opportunity. You get that stumble. Liberation Day last year, that was not much fun, but we used that to upgrade the portfolio. We got a chance to buy names we otherwise couldn't buy because there is sometimes less liquidity at time frames like that. So that's always been an opportunity for us.
And the approach here is a core approach. Can you sort of contrast that or just share your viewpoint versus a growth or value manager?
Sure. When our team looks for ideas, we don't think about it, is this a value name? Is this a growth name? We think, is this a quality business? And while the growth and value strategies, styles are worthwhile, typically they're more focused on a specific sector or specific industry. I'll take the Russell 2000 value. Massively overweight banks, 40% banks. If banks work, you're going to do very, very well. But the typical manager is going to be massively overweight banks versus the overall economy. On the other end, if you're in growth, it's massively overweight to biotech. You're very focused on individual areas of the market as opposed to just owning quality businesses. So I think we can have the best of both worlds. There are times, I think back in 2020, We had an opportunity to buy so many growth names we couldn't otherwise buy because there's a dislocation in the market. And you fast forward a year later, the market turned more value oriented because these growth names had worked. We pivoted there, and it wasn't some active decision to say we need all more growth, we need more on value. We were just looking for quality, and that's where we found the best ideas. So a core strategy allows you to have the best of both worlds.
And you often hear in the investment world gaining an edge. In this sector generally, or just your own experience, where does the edge come from in the investment process, would you say?
It's thinking differently, willing to listen to what companies have to say. And like I mentioned, qualitative analysis is kind of how I think about it. You have to meet with companies over and over again to try and discern something that's different. I like to call it there's the cool kids table. Sometimes the stocks in small cap are not at the cool kids table. So you have to be willing to kind of pull your sleeves up and do work on them to kind of discover what's different. And the other thing is a lot of investors want that short-term sugar high. That from a good quarter, a lot of times for us, we'll make an investment and it might take a year before it plays out. And then when it plays out in spades. But sometimes you have to be patient and let duration play out.
And do you spend much time sort of looking at micro caps at all, companies that could grow into a small cap that may emerge over time?
I'd say all else being equal, no. That kind of $1 billion, $1.5 billion market cap, and it's primarily liquidity. I would say that for us, though, we will take the opportunity to meet with some of those smaller companies if there's something that's unique, knowing it might be a year or two before it plays out. But yeah, the micro caps have just got a little too illiquid.
And in the current market environment, what key macro indicators do you look at? Is it interest rates, commodities, labor markets, or something else?
Sure, I'd say typically small caps trade at a discount because they may have higher interest rates if they have debt. And they can be more fragile businesses because they're smaller cap. I think that's a misunderstanding of these businesses. There are some of these that, like I said, sometimes define or dominate a niche and don't have capital issues. But I think sometimes in the short term, people don't want to look at them because it does require a little bit more work.
And shifting into themes, are there ones that you find particularly compelling right now that sort of underpin your investment approach?
Sure, I'm going to say that the AI theme, I know that's not original, but I do think this is something that's sustainable. And it is, I did live through the dot-com bubble and I have seen bubble periods. I don't think that's the case at all for AI. So right now, AI is a theme within the portfolio. That's probably the biggest one right now.
What about private equity? What are the trends there as far as being active? Are there any particular sectors they've focused on? Does that help a valuation lift sometimes?
The last 10 or 15 years, private equity had been a boon for software. And right now there is a short-term dislocation that these private equity firms are struggling a little bit more. So we haven't seen as much M&A as we would typically have. Software is one area where that's the case. But for us, these companies, we do see a lot of M&A in our portfolio. It's a handful a year. They could be either private equity or they could be strategics who want to buy a unique business that has created their own little dominant niche. And that
And,
hasn't slowed down. It's not always the private equity, but we continue to see that in our portfolio.
and moving into portfolio construction from an idea generation perspective, can you share with us? You touched on a little bit. What are the key quantitative or qualitative factors that are most important in constructing your investment mosaic?
Sure, I'd say so. We have a team of about 5 people, and we have a bottom-up process. We don't think really we consider macro, but it's more interested in finding these unique businesses. I'd say for the team and for myself, I start with management, and second is management, and third is management. And once again, these are smaller companies, and they will have stumbles, and you have to trust who you're investing with. So that continues to be probably the most important factor for the team is the quality of that management. But beyond that, we focused on companies, I said quality businesses. I don't want to take capital risk. We want to take risk on, we can be wrong on a stock, but you want to find a great business that doesn't need to go to the capital markets, that can kind of define their own destiny moving forward, independent of macro cycles. And that's pretty much in small cap. That's what's great about small cap, outside of perhaps financials and energy, which obviously more oil prices and interest rates. Outside of that, you can find great companies in small cap where you have to stress less about the macro.
And is the lens different when you look at a company that's is tied to their founders versus one that's a non-founder led company?
Typically, a founder-led company tends to be a really strong investment, and that's what I love about. Like I said, I spent a lot of my time in tech, and these are people who built these businesses, pulling their sleeves up, with limited capital, you tend to find those businesses can outperform over time. But no, I like founder-led businesses because typically they've done it on a limited budget and they've had to pull their sleeves up and do it themselves, working at night, working on the weekends. They tend to have more passion about growing their business and they care more about it.
And how do you distinguish between a company that has, say, an identifiable, sustainable competitive advantage versus one that's simply sort of riding a trend?
Gross margins always tend to be a great differentiator. That if you have a great product, you can charge more. So that's something we like to see in names that we own. In addition to that, always staying disciplined on valuation. Like I said, writing trends, where you can get in trouble there is where you don't have price or you don't have price target discipline. Because some of these companies, there are times it's fun when you have a stock that goes up materially, but they can get ahead of themselves, especially in small cap. Once they do get discovered, the discounting mechanism can happen really, really quickly and they can reach your price target. The team tends to be very disciplined about setting those price targets, but we also learn to be patient. When you have a company that's executing because they have something unique that they're doing, you need to wait and be patient and let them execute over time.
And from valuation metrics standpoint, is it sort of the standard ones, PE, EV to EBITDA, or is it a broader range of things you look at?
Sure, I'd say each sector and each industry may have different metrics that are most important. If you look at our portfolio, more than 70% of the names are valued on EV to EBITDA. And that's a metric I particularly like versus PE, because when you have high quality companies that are sitting on piles of cash, you want to give them credit for that. And you also want to give them discredit if they have too much leverage on their balance sheet. Typically, PE doesn't do that. Where PE is used more in sectors like banking and consumer, if that's what the common metric is, we will use that. But EV to EBITDA seems to be the best metric. On top of that, our portfolio, we're paranoid about free cash flow.
And what about things like insider buying? Do you use that at all as a signal in the companies, or is that not a great one?
I think it's a great signal. So yeah, for us, especially in small cap, they know more about their business than we'll ever know. And if they have the confidence to go out there and buy stock, I really like to see that.
And moving on to sort of capital allocation, what tells you, because you're putting so much emphasis on management, what tells you that a management team are good capital allocators?
Um, I think the power of experience from us being investors and also looking at the track record of management teams.
And share repurchases, given that you do have the stock liquidity issue, how do you interpret those things? Under what circumstances is that a better investment than a company redeploying capital internally?
If you have a company where I don't like buybacks is when you use leverage to do it. People don't invest in small cap for optimized capital structures. They invest in small cap for great businesses. So for me, a buyback, if you get to a point where you have excess free cash flow, so your balance sheet is in great shape and dividends might not be right for you, say in the tech sector, or if you're a consumer company, then I can see where buybacks do become a reasonable use of capital. What I don't like is if you raise debt to do it, but if it's something that becomes part of your capital structure, where if you're generating X amount of cash per year and you're spending 50% of that on buybacks, that actually is a reasonable way to deploy capital.
And we've just touched on your approach, your process. Can you share with us now what's actually in the portfolio? How are you constructing the portfolio today? What's the sector composition? Where are you overweight and possibly underweight? And what's the rationale behind it?
Sure. I'd say right now, our biggest overweight is technology. That has been a pervasive theme for the last decade. It had been a lot of software overweight. These are great businesses. Up until the last 6 months, as there's been more AI concerns, it's been a great fishing hole. Right now, we have a bigger overweight in semiconductors. Back to the AI theme, I think is sustainable, and there's some really nice opportunities to own unique businesses there. Additionally, we have a big overweight in industrials. These are great businesses in small cap. Once again, I'm repeating myself, these are companies that define and dominate niches. And we can find great names there that trade at reasonable multiples and they compound year after year. Um, Underweights right now, I say one other overweight consumer. We can find some really great companies in consumer. Once again, defining and dominating a niche, trading at reasonable valuations. And back to the stumbles and the dislocations you get in the stock market, there's been a lot of hand wringing lately about the macroeconomy and consumer spending. We can own businesses. We own a company that's a healthcare chain. And they've seen their best times have been in periods like 2008 and 2020 when the economy's been tougher. They tend to be resilient and can raise prices. So consumer, we find good ideas. Healthcare, the one area we're have a significant underweight is biotech. That is typical for a small cap core manager, and primarily because these are binary bets. If you get a drug call wrong or the FDA doesn't approve a drug, your stock's down 50%. However, what's interesting about what we've done is we're not defeatist about it. And we actually have a bigger weighting in biotech. It's somewhere between 8 and 10% of the index. And that is a lot of weight to have in names where there could be binary outcomes. But where we've had a lot of luck is finding names where they might have 2 or 3 drugs that are approved and they have a couple in the pipeline. Those are typically held in disdain by biotech investors. They want the binary outcome. So these kind of get ignored, but we can own a company that has the opportunity to have a great drug for liver cancer or breast cancer. But at the same time, if they do get an FDA non-approval letter, they still have something else in the business that continues to grow. And it's over the last 10 years, we've actually been able to add real value in biotech by doing that.
And now a word from our sponsor. If you lead or advise at a financial services firm, this may be something to keep on your radar or to share with a colleague. Harvard Business School offers leading professional service firms a 5-day in-person program for working executives to explore topics like corporate culture, talent retention, and how to deliver consistent client value. Held on the HBS campus in Boston, this program focuses on leadership and strategy by working through real challenges at professional service organizations. You'll build a global network across industries and engage directly with HBS faculty. To learn more, visit hbs.me/client. That's hbs.me/client. And the benchmark here is the Russell 2000. When constructing a portfolio, is the Russell 2000 a guide or simply a reference point?
Sure, I'd say for us, we have rules. We can't be overweight 1,000 basis points or underweight 1,000 basis points a sector. But for the most part, industrials, IT, healthcare, and financials are all somewhere between 15 and 20% of the index. For us, it is a guidepost. We're focused on bottom up. We're not going to go zero on a sector because we want to make a massive bet against it. We're always going to try to find ideas there, but we let the ideas fall where they may. So there are times when we've been overweight 400 or 500 basis points in industrials, and other times we've been 400 or 500 basis points underweight. It's more on where we find ideas. And what the team has found over time is that it finds its own level. That if there's times like our teammate in healthcare, he had a period where he couldn't find any good ideas. Some of it was government regulation, some of it was valuations, some of the quality of businesses he could find weren't very good. So we had a big underweight in software in healthcare. Then there's a period over 6 weeks, he found an idea every single week. Things came together for him, and we added more weight to healthcare. So it's more on a name-by-name basis that we built the portfolio over time, really focused on unique businesses.
And as you build that portfolio, you obviously has to balance it with stock liquidity.
Yeah.
And I'm just sort of wondering, how do you incorporate that into your purchasing? Is it through daily trading volume or something different?
Sure. Well, as a team, we sit down once a week and kind of go through the portfolio news, but we also have something we originally call our Focus Five. That's the 5 names we're working on. So what each of us will do as a teammate is say, hey, you know what? I would like to add name X to my Focus Five. And that's a chance when another teammate can say, you know what, that's a little too much leverage. Ryan, that's not what you're good at. Whatever it might be, it's a time to have that discussion before you spend months analyzing a business. At that point, we would have the liquidity discussion. So we're never going to get down the line and buy a name where we get to a point where it's in the portfolio and it no longer trades. So it's minimum daily volumes in names.
And right now we're in an environment of sort of heightened volatility, market stress. What does that mean for the current portfolio and sort of near-term portfolio construction names you might add?
Sure. For us, every name we buy, our price target's built on valuations 3 years out. And what that allows us to do is sometimes ignore the short-term volatility and just focus on the quality and the characteristics you'll get over a market cycle. So right now, what we're preaching as a team, embrace the volatility. We're going to get it. I mentioned Liberation Day provided excess volatility. We got a chance to buy some investment banking names we could have otherwise bought, some retail names we could have otherwise bought, some semiconductor companies we couldn't have bought. So it's the same thing right now. There's unfortunate events in the world, and sometimes there's excess volatility. So we're ready to embrace that, both with new names and adding to names that we own. And we're not traders, but sometimes I'm stunned how quickly you can get a 30 and 50% move in a name because of this excess volatility. So we look at it as opportunity. It is risk sometimes, obviously, too, but it's more opportunity for the team.
But I'm sort of wondering, given your experience here, is volatility really at the top of the list of the way to sort of create a position to some extent?
No, just in the short term, it's just there's more volatility. We tend to be longer term than most investors. Most people will have price targets 12 or 24 months out. Being 3 years out is a little idiosyncratic. When I walk through sell-siders, we're talking about a name, and I'll talk about that. Like, what's it look like 3 years from now? Or talk about name X compounding at 12% a year for 3 years and being 40% bigger. And their typical response is, I don't talk to anybody who thinks like that. So that's a little bit different, but no, we're focused on quality businesses. So I said sometimes you do get those opportunities because a company will miss a quarter and that can provide opportunities. But for the most part, we're looking to buy and hold names. So this volatility is unique right now as far as an ability for an entry point.
And with the brokerage firms over a period of time less active from a research perspective, does that, create sort of hidden gems at all because they're not getting research and they're easier to find?
Um, there's more hidden gems. They're still tricky to find, but yeah, there's an opportunity for us to really find names. And because hedge funds are such a huge portion of the investing universe, great business models, but they tend to be much shorter duration. So they typically are more concerned if they get a bad data point on a company today, they might exit stage left and come back in a month. For us, duration is our friend. Like I said, we're not taking capital risk. We don't need to own companies that need to go hat in hand to the capital markets to raise money. They're self-funding. So if we can be patient through 3, 6, 12 months, that's a huge opportunity for us. I even think we had owned a power backup company that my teammate for a year, he'd been on this Focus 5, and the price just wasn't right. And then there was a dislocation in the market, and we got a chance to buy it. It was a name that did really, really well after some storms and post-COVID. People didn't care about it because they'd had 2 years in a row, I think, of down numbers. That's not a cool kid stock. That's not a stock that most investors want to look at. But we knew that would improve it over 3, 6, 12 months. And you fast forward a year after we bought it, and the stock had doubled. Now investors are coming to it because the numbers look better and you're seeing faster growth rates. But we were willing to be early and wait patiently. And we got really outsized returns by doing that.
And it sounds like a little bit in this market cap range, the price of the stock may not always tell you what's exactly going on with the business because it could be volatility, could be some outside force. So I'm just wondering, what's the process? What's the due diligence you do when you've got a position, price performance is not working out? And how do you, what's the process to sort of think about maybe increasing that position?
Sure. So our process is really, really unique in the standpoint that when we have a new idea, the entire team underwrites it, not just the senior PM. They don't have final say. All 5 of us or 6 of us on the team get to sign off on every idea. So not one person can dominate the portfolio. Everybody's going to be involved in that decision. And what that allows us to do is everybody takes ownership of it. It's not my idea that's working or not working. The team's ideas are working and not working. So when you do get those stumbles, and unfortunately they happen, I think I've looked over time, and I think typically 50 or 55% of each person on the team's ideas work. I mean, it's kind of, when you think about it like that, half the time you're going to fail. It's part of the game. So when we have those times where you have those mistakes or it's not working, that is when we sit down as a team. And there have been times where my teammates said, Ryan, you know what? That was a great idea when you bought it a year ago. It's not anymore. You've had your thesis has been violated. And when you sit down as a team like that, it does help you to say, you know what, it's okay to make a mistake. But then there's the other side of it where if it's my idea and it's down 30%, you might get depressed because you made a mistake. And when your teammates say, wait a second, you bought it for these 3 reasons, these 3 reasons still hold. The only difference is it's 30% cheaper. Maybe that's time to double down. So that team process really, really is unique and helps us to have a better portfolio, I think, and have stronger numbers over time.
And what about value traps? Because you have the liquidity issue. How do you navigate those? Because those things I would think are out there from time to time. Stock looks cheap, and then you have to sort of figure out, is it cheap for a reason or is it actually an opportunity?
My least favorite word in investing is cheap. Nobody likes a cheap suit. Um, People want, I prefer to think about it as a discount to fair value. So as a team, we don't come into a meeting and say, oh gosh, you know what? This name is cheap. I like to think we think it's a discount to fair value, and here's why. In healthcare, we find a lot of times because these are small sales force selling one or two products, if you have some sales force turnover, you could have an ugly quarter. And that's an opportunity for us. Um, Also, the market can be very cyclical in the standpoint where industrials are cool and consumers cool. So there's times where there's just people not looking at a specific sector or industry, and that gives us a chance also. But yeah, the value traps, a lot of times for me, value traps are companies that might have more leverage, and that's why they look quote unquote cheap. Those are names you try to avoid. You don't want to go to the tails. You don't want to go to the hyper growth names that trade at 20 times revenue, growing at 100% plus. And also the far end where you're trading at half of tangible book value. Typically, those are names that you just want to avoid.
And is there a leverage cutoff for the ideas you look at generally?
Typically, it's about 3 times. And what we've learned over time is that when you get to 4 times, even if it looks inexpensive at a discount to fair value, at that kind of leverage, if there is a market issue or the economy slows down, you can really, really get yourself in a pickle. And the team has a list of lessons learned that we put together that are mistakes we've made over time. It's just part and parcel of this business. And one of them is leverage. And we've had times where you have a great business and they go to do an acquisition, take on some debt, and go up to 4 times levered. And it looks like a phenomenal deal. It makes all the sense in the world. And spoiler alert, the economy gets in the way. And this has happened to us in 2018 and 19. There was a kind of a housing downturn. And we had bought a name where they had done an acquisition to expand their portfolio. Great on paper, but the economy didn't cooperate. So that's for us, that 3 times is just kind of a safe number. Below that, free cash flow can help you to pay it down. And it's not high enough that the economy does slow down or your business is weak for a few quarters. It shouldn't be damaging to your franchise.
And taking profits, what drives that decision?
Um, So each name in the portfolio, we set an upside price target and a downside price target. It's a moving target. It's not static. So after earnings or after company events, we'll update those price targets. We sit down as a team and review them, looking for names that are closest to fair value. And as they get closer, if you can't justify upgrading your price target, that's a time we'll exit.
And stepping back from all this, what characteristics would you say distinguish sort of the best long-term compounders in this market cap universe? How do they stand out?
Um, Companies, when you ask the question, tell me who your competitors are, where it's a company that has limited competition. I mean, there are sectors that have multiple competitors because they're easy to dislocate a product and replace with something else. Companies that have less competition. So I think about myself and my sector focus is tech. In addition to being a PM, I love semiconductors because typically there's one or two competitors. There's not 15. So you can't dislocate. There's pricing power. So companies that have pricing power, high gross margins, tend to be better investments. So those, and it's you can look in industrials. There are so many of these companies that grow at 10 or 15% a year. That's kind of a yawner sometimes for small cap investors, but they just compound year after year. Strong margins, strong cash flows allow them to do tactical acquisitions to keep building their business. But those steady Eddie grinders tend to be some of the best names.
And customer concentration, is that much of an issue in a small cap generally?
Typically not. I guess the issue would be that you don't have as broad a product portfolio. Where a larger company might have 10 or 12 different products, smaller cap companies typically have less products, but customer concentration typically is not an issue.
We've covered a range of topics here from process to construction to navigating market uncertainty. In summary, what would you say in this year in 2026? What is the small cap playbook? What does that look like?
If, Given the excess volatility in the market, it's the ability to be patient and look through what might be a cloudy 3 or 6 or 9 months. And unfortunately, the macro is this year could be challenging to be determined. It could be awesome too. It's just there's it's choose your own adventure right now as far as where the economy could go this year. So I think for us is like I said, we're trying to buy businesses that don't have capital risk. They don't need to go hat in hand to the market. They create their own destiny because they control their own destiny because they have good business models. So it's sometimes you're just going to have to be patient through short-term turbulence and be willing to use that turbulence, embrace it to add to positions. But yeah, it's for us. I think it's going to be a great opportunity for individual businesses to stand out. I mean, last year was I think it was the worst year for active management in small cap in a quarter century. I've gone through periods like that before. I don't need to do it again in my career. But typically after that is when you find huge opportunities for outsized performance in small cap. It feels like it's setting up for that kind of environment. I mean, 2025, the number of companies without revenue, companies that are burning cash, all the characteristics that are not definitions of quality massively outperformed that last year. And from Liberation Day, typically off a market bottom, 6 or 9 months afterwards, that's what works. And we didn't change our stripes, but we're not going to buy a $15 billion market cap company that does nuclear fusion and has no revenue for the next 5 years. That's not a core quality business. We've lived through that, and it feels so much better right now that there's opportunities to buy quality businesses and see outperformance. It's still don't sleep well at night because there's just a lot of drama in the market, but it feels like a lot better opportunity to find outperformance in small cap core.
So would you say it's sort of we're entering a phase where it could be target rich?
It feels like that. I judge by our team. When we have our team meetings and people presenting ideas or saying, hey, I'd like to add names to my Focus 5, the number of opportunities people are adding, it's not a struggle to find ideas. There are times when people just throw their hands up and say, I got nothing. It feels like the opposite right now, that there's just more and more opportunities, not always actionable today, but I hear more from the team of, I got to see another 10% down and we're there. There's a lot more of that than I had heard a year ago.
Ryan, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client.